Have you ever been there, like, trying to decide where to put your money in the stock market, it feels like?
Yeah.
Well, like standing in this really crowded room, just 1,000 voices shouting advice.
Oh, absolutely. Yeah.
You've got a friend swearing by some hot tip, right? Social media is buzzing about the next big thing. And you're just trying to make sense of it all. It's honestly overwhelming, isn't it?
It really is.
That temptation to just jump on the bandwagon or, trust someone else's word, it's strong.
It absolutely can be. I mean, the sheer amount of information out there, and let's be frank, a lot of it is misinformation. It can just freeze you up, especially if you're just getting started. Feel like you need, I don't know, a crystal ball sometimes.
Exactly. Who has one of those? But what if there was let's say, a more grounded way, a more reliable path, a way to cut through all that noise, that speculation, and really understand what you're buying into, not just a ticker symbol flashing?
Yeah.
Well, that's pretty much our mission for this deep dive. We want to equip you, the listener, with a clear step-by-step framework, something you can use to analyze any stock before you actually commit your hard-earned cash.
Yeah, think of it like your own personal toolkit for investing. A checklist, really.
Okay.
We're going to break it down into, say, 3 main areas that all connect. First, just really getting the business itself, what it does, how it works, its place in the world. Then we'll dig into its financial health, the numbers that tell the actual story.
Right.
And finally, valuation. Is the price right? Because even a fantastic company isn't a good investment if you pay too much.
Makes sense.
By the end of this, the idea is you won't just be following tips, you'll be able to actually evaluate them and, decide confidently for yourself if a stock is worth your investment. Moving beyond the hype.
Okay, brilliant. Let's unpack this then. Jump right in. So step 1, and maybe the most crucial one, is simply understanding the business. It sounds almost too simple, doesn't it?
It does.
But it's amazing how often this gets skipped in the rush for a hot stock. Like, what does this company actually do? What does it sell? Could you explain it to a 10-year-old?
It's fascinating, isn't it? How many people look at the ticker before they can answer that clearly. The key thing here, really, is if you can't easily explain what the company does, its business model, who its customers are, well,
You probably shouldn't invest.
you probably don't understand it well enough, yeah.
Mhm.
Ask yourself, is the business model basically simple? Can you describe it in like a sentence or two?
Yeah.
And crucially, who buys their stuff? Knowing the customer base helps you get a feel for demand.
Yeah.
How sustainable is it?
I love that explain it to a 10-year-old test. If you can't, you definitely don't get it yourself. And building on that, once you know what they do, the next question is, okay, what makes them special? What's their unique advantage? Their moat, as they say. Is it a brand people trust, some kind of special tech or patents? Or maybe a network effect, where more users make it better for everyone? Or are they just super efficient on costs?
Exactly. That moat is what defends their profits, their market share over the long haul. Take Asian Paints, for example, from our sources. Seems simple, right? They sell paint.
Right.
But their real strength isn't just the paint, it's that incredibly strong brand they've built over decades. Plus, this massive distribution network that gets their products everywhere. Super efficient.
Okay.
Add in the fact that people always need paint renovations, new houses, and you see a clear, lasting advantage. But here's the thing people miss. These advantages aren't fixed forever. Patents expire. Brands can get damaged. So you, as the investor, need to constantly ask, is that moat getting wider? Or maybe narrower? How are they defending it?
Okay, that's a great point. And this is where it gets really interesting because, like you said, no company lives in a bubble. I mean, knowing the business is step 1. But that brings us to our second big point. You got to understand the industry it's in and who the competition is.
Yeah.
Is this whole sector booming, full of innovation? Or is it kind of mature, maybe even shrinking because of disruption?
This really forces you to ask, what's the whole ecosystem like? Is it a fast-growing area like, say, renewable energy or cloud computing, where there's loads of opportunity and the whole industry is rising? Or is it more mature, maybe even declining, where growth is flat and companies are basically fighting over scraps? Understanding the industry's growth path puts the company's own growth into perspective.
Totally.
A company growing 10% in an industry that's growing 20%, well, that's less impressive than one growing 2% when the industry is only growing 2%.
Yeah.
Context matters.
And who else is playing in that field? Who are the main competitors? How big a piece of the pie does our company actually have? We're talking market share here.
Mm,
For anyone less familiar, that's just the percentage of total sales in an industry that one company gets.
exactly.
A big, steady, or growing market share usually says a lot about their strength, their pricing power, their ability to handle competition.
For sure.
Whereas a small or shrinking share, that could be a warning sign, right? Maybe they're struggling.
Absolutely. And connecting this back, think about, say, the telecom industry in a market like India.
Hmm.
It's really consolidated now,
Yeah,
right?
just a few big players left.
Right. And that immediately tells you something important. There are high barriers to entry. It's hard for new competitors to jump in. That often means less brutal price wars between the main players and maybe better profit margins for them.
Okay.
Contrast that with an industry with tons of small companies all fighting hard. That might mean intense price pressure, slimmer profits for everyone. It's about understanding those power dynamics.
All right, makes sense. Time to roll up our sleeves and get into the numbers. This is the bit that sometimes makes people's eyes glaze over.
Yeah.
But honestly, you do not need an accounting degree for this. We're talking financial analysis, looking at the company's report card. First up, revenue growth, the top line, total sales. Are they consistently selling more stuff year after year?
Fundamental. Consistent growth suggests the business is healthy, expanding, finding more customers, or selling more to the ones they have. It's like the heartbeat, showing market acceptance momentum.
Okay.
But growth alone isn't enough if it's not profitable growth. So next, profitability. Specifically, net profit margin. This tells you how much actual profit the company keeps for every dollar of sales after paying everything taxes included.
Right.
A higher margin, or one that's stable or getting better, is usually a great sign. Shows they're efficient, managing costs well. It's the difference between, say, a super busy restaurant that barely makes money and one that's actually banking cash.
Got it. And then we get into some really powerful metrics, ones that show how well the company is being run. Return ratios. We're talking return on equity, ROE, and return on capital employed, ROCE. These sound technical, but they're super insightful.
They really are.
What do they actually tell us? Why are they so important?
Well, these ratios show how efficiently the company is using money, your money as a shareholder,
Yeah.
and all the money it has to make profits. ROE looks specifically at the return on shareholders' money, how much profit per dollar of equity. ROCE is broader. It looks at the return on all the capital used, debt included.
Okay.
As a kind of rule of thumb, aiming for companies that consistently hit, say, 15% or more on both ROE and ROCE over several years, that suggests not just good profits, but really effective management and smart capital use. They know how to put money to work.
That 15% is a great practical benchmark. But, okay, a company can look good on paper, growing sales, high returns, until you check its debt.
Ah, yes, debt.
Too much debt can be a killer, right? Especially when things get tough economically. How do we check that risk?
We look at the debt-to-equity ratio.
Mm.
Simple concept.
Mm-hmm.
How much debt is the company using compared to the shareholders' money invested? A high ratio means they're leaning heavily on borrowing, but increases risk, especially if revenues drop or interest rates go up. Now, what's high can vary by industry, but generally if that ratio gets above 1.0 or 1.5, you want to be cautious. More debt means bigger interest payments eating into profits. It can make it harder to raise more money or even survive a downturn. You want sensible debt levels.
Sensible debt, okay.
And finally, maybe most importantly, cash flow. Is the company actually generating positive free cash flow?
Why free cash flow specifically?
Because profit, on paper, the earnings number isn't always cash in the bank. Free cash flow is the real cash left over after running the business and investing to maintain it. You need that real cash to operate, invest for growth, pay dividends, buy back stock.
Ah, I see.
Companies can sometimes play games with accounting profits, but cash flow, much harder to fake. It's the real deal.
The Infosys example you mentioned from the sources really drives this home, doesn't it?
It does. Consistent revenue growth, solid profit margins, not much debt.
Hallmarks of good financial health.
Yeah.
Generating strong cash. So, okay. We figured out what the business does, who its competitors are, the financials look solid. Now, the crucial catch. Even the best company can be a bad investment if you pay too much for it.
Bingo.
This is valuation, making sure you get a fair deal.
Absolutely critical. It's like buying a house,
Yeah.
right? Even if it's your dream house, you wouldn't pay 5 times what it's worth.
No way.
Same with stocks. We use metrics like the price-to-earnings ratio, PE, or price-to-book, PB. And another useful one is EV/EBITDA, enterprise value to earnings before interest, taxes, depreciation, and amortization. Bit of a mouthful.
Yeah.
But these ratios help us figure out if the stock price seems reasonable compared to its earnings, its assets, or its operating cash flow. The PE, for instance, tells you roughly how many years of current earnings investors were paying for one share. PB compares the price to the company's net asset value on its books. And EBITDA is great for comparing companies with different debt levels or in heavy investment industries because it looked at the whole company value relative to operational cash profit before certain charges.
So it's not just about one number in isolation then. It's about context, comparison.
Exactly that. A PE of 30 might sound high on its own.
Yeah.
But if that company's growing its earnings at, say, 25% a year, maybe it's actually pretty reasonable. You need the context.
So compare it to its own history.
Yes, compare it to its own history, and critically compare it to its direct competitors in the same industry and the industry average. What's expensive for a steady, slow-growing utility company might be totally normal, even cheap, for a high-growth tech company.
Okay.
A high PE for a fast grower might be justified if earnings are expected to soar. But for a mature, slow-growth business, that same PE could scream overvalued. The real skill is understanding why it trades where it does and if those underlying expectations make sense.
This is where it gets kind of nuanced, I think, because numbers are one thing, but the people running the company, that's another story. Our fifth key point, management quality. Good leaders can take an average company and make it great. And bad leadership, they can sink even the best business, regardless of the product or market. It's like the conductor of the orchestra analogy, right?
That's a good one. Even with the best musicians, a bad conductor can ruin it.
So true.
And this is often overlooked, but has such a huge impact. So how do you judge management if you can't, sit down with them?
Yeah.
You look at things like promoter holding. Do the founders or top execs have a lot of their own skin in the game? A high stake usually aligns their interests with yours. You also check their track record on corporate governance. Any past controversies? Are they open and honest in their reports and communications?
Transparency.
Yes. And do they use capital wisely, making smart calls about reinvesting profits versus giving them back to shareholders?
It's almost like checking their character, their integrity.
In a way, yes.
And a subtle sign, often mentioned in the sources, is dividends. Are they paid consistently? How is that trend looking over time?
That consistency in dividends often signals financial discipline, a commitment to shareholders, and usually confidence about future cash flows.
Okay.
If dividends are all over the place or suddenly cut, that could be a red flag. Maybe financial stress, maybe growth wasn't sustainable, or management just isn't prioritizing shareholder returns. It's fascinating because management is often that intangible X factor that can make or break it, even if everything else looks good on paper. Their decisions shape the future.
Okay, so we've got a good handle on the company's present, its past performance, but investing is about the future, right? So our sixth and final point for analysis, future outlook and risks. What does the road ahead actually look like? What's going to drive growth?
You absolutely have to think about that. What's going to push the company forward in the next few years? Maybe it's launching cool new products, maybe expanding in new countries, maybe getting a boost from government policies or demographic trends.
Like a tailwind.
These are the growth catalysts, the things that make a good company even better. But, and this is just as important, you have to look hard at the potential downsides too, the headwinds and risks.
So what could potentially trip them up?
Things like new regulations that totally change the game, or maybe tougher competition from some nimble startup, or maybe a disruptive technology comes along and makes their main product obsolete,
Oof.
or even just bigger economic stuff, recession, supply chain chaos, things like that. A balanced view looks at both the upside potential and the possible pitfalls. It forces you to think critically, not just like a cheerleader.
Gotcha.
You want to understand the range of possibilities. A company with clear growth drivers, but also risks that seem understandable and manageable. That's often more attractive than one with huge promises, but a bunch of unacknowledged threats lurking.
Okay, wow. That's quite a framework, but it feels really practical, really actionable. So just to quickly recap that for you, our listener, that powerful 6-step checklist we just walked through for analyzing a stock. 1, really understand the business, what it does, customers, its moat.
Yep.
2, analyze the industry and competition, growing market, rivals,
Market share.
crucial content. 3, dive into the financials, revenue growth, profit margins, those key return ratios, ROCE, manageable debt, strong free cash flow.
The numbers story.
4, Check the valuation. Is the price reasonable compared to peers and history? Don't overpay.
Okay, good deal.
5. Assess management quality and integrity. Who's running the show?
The people factor.
And finally, 6. Consider the future outlook, growth drivers, and potential risks.
Look ahead, realistically.
That's the checklist.
And beyond that, maybe just a few essential practical tips that came up in our sources. Like, please never invest just based on tips, or what a friend says, or social media hype.
Oh, definitely not.
That's just gambling, not investing. It rarely ends well.
So true. Instead, look for consistency, right? Not just those flashy, quick spikes in price.
Exactly.
Those jumps might feel exciting, but it's that long-term, steady growth in the actual business fundamentals that builds real wealth over time.
Yes. And please, please diversify. Don't put all your eggs in one basket.
Absolutely fundamental.
Don't sink all your hard-earned money into just one stock, no matter how amazing it seems. It's basic risk management.
Cushion the blows?
Diversification helps cushion you,
Yeah.
against the ups and downs of single companies. And maybe the biggest tip underpinning everything, invest for the long term.
Patience.
The market's going to be noisy day to day, week to week, but quality companies, chosen carefully using a framework like this, they tend to compound value over years, even decades. Patience really pays off in investing.
So as we wrap up this deep dive, it really boils down to this core idea, doesn't it? Analyzing a stock isn't about trying to guess tomorrow's price or chasing some hot trend.
Not at all.
It's about building a deep, solid understanding of the company itself, its business, its numbers, its leaders, and then making an informed judgment about its potential to grow steadily, reliably over many, many years. It just feels like a much more, I don't know, grounded way to do it. Less stressful and probably more rewarding in the end.
It truly is. And remember that powerful shift in perspective we talked about. You're not just buying a stock. You are buying a piece of a company.
Yeah, that changes everything.
It really does. It shifts your focus from just watching a ticker symbol bounce around to having a genuine interest in the actual business, how it runs, what its future looks like. You start thinking like an owner.
Right, like an owner. I like that. So keeping that in mind, here's a little something for you to think about, maybe explore on your own after this. What does it really mean to own a piece of a company? Don't just think abstractly.
They get real.
Pick a company you admire, maybe one whose stuff you use every day. Could be your favorite coffee chain, your phone company, the people who make your running shoes, whatever. Now, take this 6-step framework we've just gone through and try applying it to that company. What surprising things might you discover when you look past the brand name or the stock price and really dig into the business itself? Give it a try. We think the insights might genuinely surprise you.